Right. I'm seeing the number is growing, and I would really, really still request you great people to bring in your friends. And ensure you're bringing in your friends so you can get even a better quorum. All right. I think the better thing to do is for us to get started. We need to get started. I'm so sure you're also putting in some efforts. So sure you're putting in some efforts so that by the end of the session, we should be having great numbers joining in. All right. So for those students that have never taught before, ladies and gentlemen, for the students that have never taught before, ladies and gentlemen, okay. So for those students who have never met this Mwalimu before, my name is Dr. Joshua Aura. I'll be the one in this case here taking you through this great subject known as advanced financial management, advanced financial management. Now, I would want first of all to know, what have people told you outside there regarding this subject called AFM? Are there people trying to scare you that this paper is among the toughest paper that we have in KASNEB? Is there anybody who is coming in this case here already like scared? Already scared? Anybody who is coming already scared? Anybody who is coming already scared? Anybody who is coming already scared? Please go to the comment section and tell me, what have you been advised regarding this paper? What have you been advised regarding this paper? What have they told you outside there? Let's try to talk. We're trying to know each other, Let's try talking here. We're trying to know each other. Is there anybody in this case here who will be threatened by the name advanced? Is there anybody who will be threatened by the name advanced? Is there anybody who will be threatened by the name advanced? No. This is the best paper ever. I can assure you, ladies and gentlemen, at the end of the day, you will never get any paper that will be better than this paper called what here? Advanced Financial Management. And I would want us to share. I would want us to share something here with yourselves. All right. So this is how the course outline looks like. This is how the course outline looks like, given to us by KASNEB. This is how the course outline looks like. Very nice. So you can see paper number 15. It's called Advanced Financial Management Unit Description. This paper is intended to equip the candidate who is yourself with knowledge, skills, and attitudes that will enable him or her to apply advanced financial management techniques and methods in a practical work environment in both private and public sectors. Learning outcomes A candidate who passes this paper should be able to make advanced capital budgeting decisions and make appropriate capital structure decisions for an organization. Two things there: capital budgeting and capital structure decisions. Number two, he should be able to evaluate portfolios and apply CAPM, what we call the capital asset pricing model, and other multi-factor models in financial decision making. And then we have number three, apply the relevant models and skills in prediction of corporate failure. Ladies and gentlemen, of course, we as accountants, we as finance managers, we know we are supposed to be at a position of resuscitating. Coming up with better plans, management and financial plans to ensure that a firm that is almost bankrupt there can get its 2 feet and move on. So that then I shall be able to teach you something to do with corporate failure. Apply derivatives in financial risk management and apply international finance concepts, evaluate mergers and acquisitions, undertake corporate restructuring and reorganization, apply valuation techniques in real estate finance. Then today I would want us to look at the first topic, because really, I don't prefer going through the entire course outline, and yet you're only going to do like the first topic here. So we are talking about advanced capital budgeting decisions, where we are required here to know how to incorporate risk, stroke uncertainty in capital investment decisions. 1.2, techniques of handling risk, basic methods of analyzing expected monetary value, EMV, the standard deviation and the coefficient of variation. 1.3, advanced methods of analysis, that is sensitivity analysis, scenario analysis, decision trees, simulation analysis, very easy things, utility analysis, risk-adjusted discounting rate, RADRE, and the certainty equivalent method. Impact of financing on investment decisions, the concept of adjusted present value, very, very popular in your exams. Incorporating capital rationing in capital investment appraisal, single period capital rationing with divisible projects, multi-period capital rationing with divisible capital investments. Incorporating inflation is very popular, 1.6. Incorporating inflation in capital investment appraisal, we have evaluation of projects of unequal lives, the equivalent annual annuity approach, and the replacement chain analysis, constant scale, finite period, replication criteria. Then we have project duration as a measure of risk. Project duration as a measure of risk. Here we shall be looking at what we call the Macaulay's duration. Macaulay's duration is also very popular in your exams. 1.9, we have the real options in capital budgeting, characteristics of the real options, types of options in capital investment, appraisal, strategic investment option, expansionary option, timing option, option to delay a project, abandonment option to withdraw a project, the replacement option, and the option to redeploy a project. Challenges in use of options in investing analysis. We have common capital budgeting pitfalls. So, ladies and gentlemen, I will just keep it there in terms of our syllabus, because number one, we would really want today to do this concept of investment appraisal. That's what we are doing. In the investment decision. Ladies and gentlemen, remember, as finance managers, we are wealth creators of organizations. We want to create wealth. And how do we get to create wealth? One of the things that we need to do to be able to create wealth is to ensure that companies invest wisely. If, for example, they have given you like 10 billion budget to work with, and they've got, say, 4 projects, A, B, C, and D, you as the finance manager, you have to be involved in what we call project appraisal. We must do what we call project appraisal. So appraise A using NPV, for example, B, C, D. Once you calculate, in this case here, the NPVs, if that is the criteria you've chosen to work with, then you will be able to choose the project, go by the project that has got the highest net present value. Go with the project that has got the highest net present value. So if you are me, ladies and gentlemen, I have notes. At this level, I will be giving you textbooks. I will be giving you, ladies and gentlemen, materials, so you don't waste a lot of time, in this case here, trying to look for, writing notes. No, not at this level. These are serious level. We should be able to get easier ways of working things out. Easier ways of working things out. Easier ways of working things out. All right. Thank you so much. Sorry for the background noise. We shall overcome. Now, ladies and gentlemen, I'm sharing some notes here so that you guys can appreciate exactly what I'm talking about tonight. And I would want to take this opportunity to invite all of you to join my advanced financial management classes. It will be a pleasure really having all of you joining them. If you're interested in joining us, of course, our usual number is 0719 525 000. 0719 525 000. All right. All right. Now, ladies and gentlemen, here I am. Please remember, up there they told us that we have to think as finance managers. We are finance managers, and they want us to be very practical. They want us to be very practical. So you can see we have here the financial management function. I mean, if, for example, you are to be employed today to be a finance manager of a Safaricom, what are those key responsibilities that you will be really engaged in? What will you be doing like every other day? Now, ladies and gentlemen, you can see here on my screen, I hope this is financial management you can see. So we have things that you must always know, like the nature and the purpose of financial management. I'll be able to tell you what is financial management. You did this in intermediate level, but I'll not make that assumption. Even if this is advanced, I'll still have to start that low. I'll tell you, ladies and gentlemen, that we have got various stakeholders who are really competing against the resources of this company. We have employees who would want, at the end of the day, to get very high salaries. We have directors who are coming to make noise at the board meeting and they still want to be getting 100,000. So you're going to see the agency theory and how do we get to mitigate these risks. So at the end of the day, as a finance manager, I should be able to ensure that the company is able to maximize what here, the wealth, the role of management, and the goal congruence. Because at the end of the day, the goals of these various stakeholders must agree. So we have the conflict, the agency theory. These are things that you guys will be able to study as we get along. So the nature, and I'll be able to give you this, don't copy anything here. The nature and the purpose of financial management. Financial management is concerned with the efficient acquisition and the deployment of both short and long-term financial resources to ensure the objectives of the enterprise are achieved. Ladies and gentlemen, at the end of the day, you will be the person who will be involved in acquiring capital. So if, for example, you're looking at capital, and in most cases, our capital will come from two major sources. So it will come from two major sources. So we have the debt here, and then we have what we call equity. We have the debt, and then we have what we call equity. So there is no way you as a firm will rely on 100% debt. No bank will be able to give you debt like 100%. No, they always want you to put in some capital, you as the owners. So you must have some equity. You must have some equity. So we have here debt vis-a-vis what here? Equity. Very, very important. So what we are saying, ladies and gentlemen, at the end of the day, we shall have what we call the optimal capital structure. You will get firms like, for example, breweries is operating on 60-40%. 60% being what your debt, 40% being what your equity. Remember, debt has got more advantages. Debt has got more advantages as compared to equity shall be looking at this. But we're saying the role of the finance manager is to get involved in acquisition of financial resources for both short-term, like overdrafts, and of course, we have long-term. So long-term, we're looking at things like bonds and what year equity. You saw them talking about up there that we must be great finance managers for both private company and public sectors, public organizations. So for example, you're told here to be the Minister of Finance in Kenya here. So you see now, very many countries will not want to give you like now this external debt. The foreign borrowing is really going down. So then you must be able to know how do you squeeze these citizens here to be able to finance their company, to be able to finance their country. So in this case here, increased taxes. That's equity coming from what year? So we must really be able to know how do we strike the balance so that in this case, the citizenry does not cry forever. And of course, we'll be able to get what we call sustainable debt. Now, ladies and gentlemen, please listen. Ladies and gentlemen, please listen here. Please listen here. Ladies and gentlemen, please listen here. We are told here, I'm repeating, that financial management is concerned with the efficient acquisition and deployment of both short and long-term financial resources to ensure the objectives of the enterprise are achieved. Decisions must be taken in three key areas: investment, which we're looking at today, both long-term investment in our current assets and short-term investment in working capital. Number two, we have finance. From what sources should these funds be raised? Do we raise these funds from the owners of the company? Or do we raise these funds from banks? Do we borrow dividends? After, in this case, we are able, ladies and gentlemen, to get now our investment has been done very well. First of all, we have acquired funds, 10 million. We've been able to put these funds into optimal assets. So now these assets are producing profits. Then again, as a finance manager, I have to jump in like a great ninja. I have to jump in like a great ninja and help this organization to say out of, for example, 4 million earned as a profit, how much dividends, what appropriations do we do? Great finance managers will never pay 100% ratio as dividends. But we get profit of 4 million and then we pay 4 million. That means that you're not looking at the future. We need reserves in companies. So basically, when you're a finance manager, you'll be making so many other decisions, but procurement of financial resources, ensuring that those financial resources are invested optimally. And once you get fruits out of the assets you've been able to buy, then you need to know how to appropriate. You need to know how to give out these fruits again to the owners of the business optimally. Now, ladies and gentlemen, please listen. Now, the next thing that I'm going to talk about here is basically the concept of what here? The concept of investment appraisal. Now, we're looking at what we call the investment decisions. We are looking at what we call the investment decisions. We are looking at the investment decisions. So this is basically, I've done the introduction. Even if I haven't really written that for you, you'll be able to get the notes later after class, immediately after class. But now, from now here, moving forward, you have to write your notes. So now we are writing there, investment decisions, investment decisions. Of course, ladies and gentlemen, the assets that we bring will be giving us cash flows in the future. They'll be giving us cash flows in the future. And whenever cash flows come to us in the future, as a finance manager, we have to get those cash flows from the future. We bring them to today. We must do what we call present valuation. But before I teach you what we call present valuation, please allow Mwalimu to teach you a very important concept called compounding, because they are very related. Compounding. Just mention there, compounding. Compounding. And if you remember very well, ladies and gentlemen, compound interest is not something new. We must have done this in high school, where we said amount equals principal into 1 plus r raised to power n. Is there anybody who is able to remember this formula? Is there anybody who is able to remember this formula? That amount equals principal into 1 plus r. I'm so sure some of you did your high school long time ago. But somehow, even if it's vaguely, Is there somebody who is able to remember this formula? Yes, I will be able to update Hassan Mohammed. I'm so sorry for that. We shall overcome. Great, at least V is lifting up her hands. But this is amount. This is the principle, what we're going to invest here today. So we have amount, principal, raised to, or rather into 1 plus R raised to power N. N is the time period. N is the time period. Now exercise, I hope you have written that this is a component amount. So exercise, if principal is 1,000 and the rate of interest is 10%, and we invest this amount for 5 years, what do you think in this case here will the amount that we shall receive be? Is there somebody who can advise here? Is there somebody who can advise here? So we have been given, ladies and gentlemen, a situation where the principal amount, what we are investing today, is 1,000, is 1,000, is 1,000. The rate of interest is 10%, and the N is 5. N is 5. So is there somebody who can advise us here? Is there somebody who can advise us here? So, ladies and gentlemen, what we shall have here is amount equals principal of 1,000, principal of 1,000 into 1 plus R, R of 0.1, R of 0.1, R of 0.1 raised to power N, N which is what here? N which is 5, raised to power N, N which is what here? N which is 5. So let me pull this board a little bit like that. Let me pull this board a little bit like that. So we have amount equals, I'm just placing here, it's placements basically, because the principal, I'm following this formula. Principal is 1,000 into 1 plus R, R which is 0.1, raised to power N. So if you allow me, ladies and gentlemen, this amount here will be 1,000 times body mass, brackets, we have 1.1, raised to power 5. 1.1, please ensure that in your calculator you know how to raise. Ensure that on your calculator you know how to raise like this. Ensure in your calculator you know how to raise. So you say 1,000 times 1.1, and then you punch this, raise to power 5, and then please give me an answer. Is there somebody who is able to give me an answer here? Is there somebody who has a, don't worry, I'm recording this. Don't worry, I'm recording this. I'm recording it. Don't worry how I'm doing it. I'm doing it remotely. I'm recording it. I can see Anne giving me 16, 10.5. I can see I have great ninjas here, great students here. I want to hear from the other students. Please ensure that you are raising really. It is amount equals 1,000 times 1.1 raised to power 5. Maureen has confirmed. Do we know how to raise all of us? If we know how to raise all of us, then we can never ever go wrong. We can never ever go wrong. So they're giving me a figure of 1610.51. Thank you so much. Thank you so much. So then at the end of the day, this person will come and peak 1610.51. Remember, he had invested how much? Just 1,000. But at the end of the 5th year, he'll come and peak 1610.51. So in this case here, 610 is the interest payable. 610 is the interest that this guy will be getting. Ladies and gentlemen, remember it is wealth being created simply because you have given out your money there wisely. Somebody is doing business with your money, and then you get to share, you earn interest. You earn interest like that. You earn interest. Now, I would want to try you great students of mine. I would want to try you great students of mine. And please, I can see the number here is very good. And I would again not hesitate to welcome all of you to join my AFM classes. We are charging 4,800 Kenya shillings. 4,800 Kenya shillings. 4,800 Kenya shillings. 4,800 Kenya shillings. And if you are interested, ladies and gentlemen, then we shall be able to work together throughout the semester to ensure that you get to succeed. You know, that is the essence of these classes. You succeed. So compounding, a sum invested today will earn interest. Compounding calculates the future or terminal value of a given sum invested today for a number of years. To compound a sum, the figure is increased by the amount of interest it would earn over the period. Very interesting here. We are told here an investment of 100 is to be made today. What is the value of the investment After 2 years, if the interest rate is 10%, is there somebody who can give me this simple arithmetic here? Is there somebody who can give me this simple arithmetic here? Now, the principal, what we're investing today is 100. What is the value of the investment after exactly 2 years if the interest rate is exactly 10%? If the interest rate is exactly 10%. Is there somebody? I've already given you the compounding formula. Because today you're investing 100. Then you go away. Each year, this money will be earning some interest. What is the value of the investment after 2 years if the interest rate is 10%? So is there somebody who can give me this arithmetic, very simple arithmetic? Anybody who is able to give me this very simple arithmetic? Yeah, it is the same as capital budgeting. Same as capital budgeting. I can see Shiko Mwaneki saying learn and relearn, which is very good. I hope Shiko Mwaneki have finished here. 121. All right. So remember the principal amount. Thank you very much for trying. Thank you very much for trying. And I hope all those who are following me on YouTube, those who are following me on my LinkedIn handle, Facebook, I expect you great students as well to give me answers as comments. You comment there. You comment there. And of course, don't forget to subscribe to my channel. So the principal amount is 100. Number of years, we are talking of 2 years. And then rate of interest is 10% per annum. So we have just said here that the amount, we know the formula, is principal into 1 plus r raised to n. So the amount, ladies and gentlemen, here will be the principal, which is 100 here, into 1 plus the rate of interest is 0.1 raised to power n, which is power 2. Then this amount here will be 100 times 1.1 raised to power 2. So is there somebody now who can really raise this for us very well? They are telling me, Mwalimu, this one, don't mind about it. It is 121. It is 121. So that's how we are getting this compounding. Before I teach you, the language of calculating NPV, calculating in this case here the profitability indices, doing IRR, that language is a language of discounting, which is the opposite of what here? Compounding, which is the opposite of compounding, which is the opposite of, before I teach you discounting, first of all, we must appreciate what compounding is. Now, ladies and gentlemen, please, if you allow me, I'll be able to, this is quite simple now. I don't really have to belabor here. Like now you have 5,000 to invest now for 6 years at a rate of interest of 5% per year. I don't think we should belabor there. Maybe I just do it for the sake of it, but I think this is a subtopic here, a sub area that already we have done lots of justice to it. So we have here amount, ladies and gentlemen, here, the amount, ladies and gentlemen, here will be that principal, which is 5,000 into 1 plus the rate. You see, 5% is the same as 0.05. 5% is the same as 0.05 raised to power 6 because it's after 6 years. It's after 6 years. So then this one here will be amount will be equal to 5,000 times 1.05 raised to power 6, which will end up giving us what figure, ladies and gentlemen? Is there somebody who can advise? Is there somebody who can advise? Now that you have this book, you guys, you are really good to go. Good to go. And it has got answers at the back. It has got answers at the back. You should be able to go and do what here? Do a lot of research there. You should be able to go and do a lot of research there. So is there somebody who can raise this 5,000 times 1.05 raised to power 6 and ensure that all of us know how to raise? Don't take it for granted. I'm giving you an opportunity to know how to raise. I'm giving you an opportunity for you to know how to raise. Everybody must 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 know how to raise. They're telling me it's 6,700.5. Thank you so much, ladies and gentlemen. We get to the gist of this exercise. What now we are calling discounting, the language that we shall be using for capital budgeting, the language that we shall be using for investment appraisal purposes. We are told discounting, in a potential investment project, cash flows will arise at many different points in time. To make a useful comparison of the different flows, they must all be converted to a common point in time, usually at the present day. At the present day, i.e. the cash flows are discounted. They're discounted. Ladies and gentlemen, if you're writing there, please tell us that there are two types of cash flows. Tell us there that there are two types of cash flows. 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 So we have in this case here what we call irregular, and then number two, we have what we call regular, or basically what we also call the annuities. So we have irregular and what here and regular. Yes, I'll send the notes to you. I'll send the notes to the group. I'll send the notes to the group. There are basically two books that we shall use throughout. So we have two types of cash flows. We have irregular and regular. Irregular are the ones that we call non-uniform. At times, in this case here, we use these to discount what we call lump sum amounts. Non-uniform or lump sum cash flows, non-uniform or lump sum cash flows. As in, for example, ladies and gentlemen, you invest in a project. End of year 1, you get 10. End of year 2, you get 20. End of year 3, you get 15. Different amounts. Or you invest in a project today, and then you simply get a lump sum at the 10th year. You get a lump sum at the 10th year. You get a lump sum at the 10th year. You get a lump sum at the 10th year. Then, ladies and gentlemen, that one, you have to really appreciate this irregularity. And the most important thing that you're supposed to know under irregular cash flows is that we use PVIF. We use what here? We use PVIF to discount. We use PVIF to discount irregular. We use PVIF to discount irregular cash flows. So anytime you see irregular cash flows, today you are getting 10, another day 15, another day 30. Cash flows which are irregular, to discount them, we shall be using what we call PVIF. Please write there in full that PVIF stands for present value interest factor. PVIF stands for present value interest factor. PVIF stands for present value interest factor. So this PVIF stands for present value interest factor. Just for any inquiries that you guys will be having, because you know, like last semester at FM, we had over 500 students. FM, we had over 500 students, and I would really plead with you to ensure that we get those 500 students this semester. Actually more. If we can double the better. If we can double the better. So my number, or the school's number, is 0719 525,000, and we're only charging Kenya shillings 4,800. Thank you so much. And what have we said here? That anytime we get non-uniform cash flows, we shall always use PVIF. And the PVIF is present value interest factor. 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 Present value interest factor. Present value interest factor. Ladies and gentlemen, the thing that you're supposed to appreciate here is that your present value interest factor, the formula is 1 plus R. Because now we are discounting, we are subtracting. So in this case here, raised to negative n. So we have here 1 plus R raised to negative n. 1 plus R raised to negative n. Please listen, my good students. If, for example, today, we have here a 2-year program. So we have here year 1, year 2, like that. Here you are investing, in this case here, 100. This is what you are investing. This is the principal, all right, which we would want to know by end of year 2, it will amount to what? And then R is 10%. R is 10%. Is there somebody who can do this abracadabra for me? Just 2 years. It's a 2-year program. 2-year program. It's a 2-year investment plan. And today they are investing 100. Today they are investing 100 at the rate of interest, which is 10%. At the end of year 2, this ninja will be getting how much? This ninja will be getting how much? So Lexus is telling me 121. What Lexus has done, Lexus has appreciated our formula of getting amount. So to get amount, ladies and gentlemen, we normally say amount is principal into 1 plus R raised to power n. Remember, amount is also the same as future value. Amount is also the same as future value. So in this case here, the principal amount, what they have invested today is 100 into 1 plus R. R is 10%. R is 10%, and this is coming after 2 years. This is coming after 2 years. It's coming after 2 years. Coming after 2 years. So remember, our R is 0.1. So you're taking here 100 times 1.1 raised to power 2. Raised to power. I don't know how they're getting 82.64. I don't know how they're getting 82.64. I think they're discounting. I don't want to discount. Remember here today, they have given you 100 bob. And they're asking you, you have invested this 100, so it should grow. It should compound. You know, this is compounding. This is compounding. So if you take 100 times 1.1 raised to power 2, let's first of all be in agreement. Here we are compounding. Why? Because this person is investing today 100, is investing today 100, and then waiting to see how much will he accumulate and get as principal and interest. So amount, it should be the compounded formula here. It should be the compounded formula. So is there somebody who is able to get Dulo? Check this. Just get your calculator. Don't use a negative here because we are not discounting. Don't use a negative here. We are compounding still. So in this case, it will be 100 times 1.1 raised to power 2. Let's first of all get the same answer, all of us. All of us. I would want all of us to get that 121. Are we able to get 121, all of us? Because you see, today we are investing here, and then we get an amount. So in this case, the amount will be 100 what here? 121. I would want us, ladies and gentlemen, to look at this. Please look at this. This is what we call the present value. This is 100. And this amount, which has got interest in it, is what we call future value. This is what we call future value. Future value. They are normally related. So whenever I'm moving from present value to future value, I compound. Whenever moving from present value to the future, we compound. And whenever you are moving from future to present value, from future here to present value, then we talk of what here? Discounting, because present value must always be smaller. Present value must always be smaller. Please listen. Forget about even the illustration that I've just given you. It'll just give you a headache and a heartache at the same time. The most important thing that I would want all of us to appreciate, ladies and gentlemen, is that whenever we're given a lump sum amount, so for example, somebody tells you like an exercise here, that we expect a cash flow of 121 at end of year 2. At end of year 2. And then you are given here R is 10%. You're given R is 10%. And then you are required to calculate, present value. You see, somebody expects to get Kenya shillings 121 at the end of year 2. So that is an amount which is in the future. It's an amount which is in the future. And then you are asked here to do something very simple, to present value that amount. To present value that. Then I will remember very fast. For non-uniform cash flows, or cash flows that I receive just at once, like this 121 is a lump sum amount, then I shall use PV. So solution. So here, ladies and gentlemen, solution, because it's lump sum. It's a lump sum, one of figure. Use PV. Because it's lump sum, one of figure, use what we call PV. You use PV. And how do we get this PV? We know don't we? We know the formula of PV. PV is 1 plus R, because it's present value, I'm negating. It's present value, I'm negating. Because I'm discounting, ladies and gentlemen. So then in that case here, to get this PV, it will be 1 plus The rate of interest, which is 0.1, raised to negative n, where n is 2 years. Is there somebody who can just give you this PVF in isolation? Do we have anybody who can give us this PVF in isolation? Is there anybody who can give us this PVF in isolation, single-handedly, alone? PVF. You say 1.1 raised to, how I wish everybody would just do exactly what I'm saying there. 1.1 raised to negative 2. How I wish everybody would do exactly what I'm saying here. 1.1 raised to negative 2. 1.1 raised to negative 2. So you're getting 0.8264. So this is 0.8264. This is 0.8264. 0.8264. Thank you so much. This is PVF. This is PVF, which is 0.8264. Thank you so much. 1.1 raised to negative 2. 0.8264. Now, ladies and gentlemen, once I get this PVF, then to get the total present value is a walk in the park. To get the total present value is a walk in the park. So to get the total present value, I will take the cash flow involved times PV that I've obtained. The cash flow is 121 that I will be receiving at the end of the second year. So I'll come and take 121 times this PV, which is 0.8264, like that. So then are you able to give me the final answer? Are you able to give me the final answer now? Is there somebody who can easily give me this final answer? Is there anybody who is able to give me this final answer? Anybody who is able to give me this final answer? All right, yes. It's coming to 100. It's coming to 100 here. So it's coming to exactly, and I saw most of you really had gotten this. You were able to play with these figures here to get 100 and 121. So can we put a tick about this and then we move forward, ladies and gentlemen? Can we say now that we are a bit comfortable with this? But again, feel free to ask questions. The most important thing is that when you are moving from the future value to present value, we are discounting. We are discounting. This is so special to me. It's very close to my heart. Very, very important. Very, very important. Now, ladies and gentlemen, if, for example, you're given this kind of a question here, what is the present value of $115,000 receivable in 9 years' time if R is 6%? Let me try you with this. Present value of $115,000 receivable in 9 years' time if R is 6%. Is there somebody who can help me with this? What is the present value of $115,000 receivable in 9 years' time if R is 6%? If R is 6%, I'm giving you exactly 2 minutes to see whether you great students of mine will be able to knock these down pretty fast. Whether you great students of mine will be able to get these pretty fast. Pretty fast. So remember, they want us to give them present value of 115,000, a future cash flow receivable in 9 years' time if R is 6%. If R is 6%, I hope they have copied the formula. All right. I like this. This team, I'm already liking it, you know. I'm already liking this team. I'm already liking the team. So now I'm going to give some presents here by the end of the session. But do we have anybody who got this kind of a figure here? 68,068. Is there anybody who got this kind of a figure? 68,068. 68,068. Let me see from your suggested answers. 68,068. Let me see from your suggested. Yes, yes, yes. This is very correct. I have very brilliant students here. What these students have been made to understand, ladies and gentlemen, is something straightforward, really. And you're going to see this in your past papers. Very, very common. So, ladies and gentlemen, here we have our future cash flow. They have given us our future cash flow. Future cash flow. They have given us our future cash flow, which is 115,000. And they've told us 6%, and is 9 years, and is 9 years. So then how do we get total present value? Now here we are discounting, remember, because they've told you that the 115,000 will be received after 9 years. And I want its present value. So then the total present value will be 115,000 times PVIF. PVIF 6%, 9 years. PVIF 6%, 9 years. PVIF 6%, 9 years. There is a ninja there who can't hear. Are you guys able to hear Mwalimu? If you're able to hear Mwalimu, are you able to advise Abdullahi to get out, please? I can't type because I'm trying to talk quite fast. Are you able to advise Abdullahi to get out, and then he comes back? And then after full stop, we tell him, when he joins with sound. There's a place you'll see, join with sound. You join with sound. Please advise him. Somebody just type for him very fast. Get out of the meeting, come back. And when you come back, join with sound. Always, you shall join with sound. If you don't click on the sound thing, you'll not be able to hear anything. You won't be able to hear anything. Nothing. All right. So then we shall be able to come, ladies and gentlemen, here and say that the total present value will be 115,000. We know the PV formula. It is 1 plus R, which is 0.06, raised to -9, like that. Raised to -9, like that. Raised to -9, like that. Ladies and gentlemen, this is what was able to give these guys the 68 something. So today is our very first class, and I should not really get to bore you with a lot of content. We normally have these classes 3 times a week: Friday evening, Saturday evening, and Sunday evening, 8 p.m. to 10 p.m. 8 p.m. to 10 p.m. So now I'm looking forward to meeting you tomorrow, but today we may not have covered it a lot, but we have known that the finance manager will be looking at the trickling in of financial resources. How are they coming to the company? Debt, equity. Put this together. Of course, you have preferential capital as well, but basically the main ones are debt and equity. Put all of them together. Invest this. Put this in good investment vehicles. We get a return. We do what here? We pay dividends. Because you must keep stakeholders happy, satisfied. That's what we call stakeholder management, stakeholder theory. Otherwise, the agency relationship will not hold totally. And it's an investment appraisal that we shall be able to dwell there, and I'll be able to read for you the course outline given to us by KASNEB. So for those of you who have never seen this Mwalimu before, again, I'm repeating, my name is Dr. Joshua Aura. I'm the one who will basically be on the wheels of this bus written there, AFM. And of course, as you are aware, RCM College is the biggest college in this region, especially on matters of AFM like that. We are the biggest in this region here. So in terms of quality, of course, many students cannot be wrong. When you see many students following us, there must be a reason. They are simply coming to us because they are able to see what here, they're able to see quality. If you want to talk to us, this is our number. Don't hesitate. Just get in touch with us tonight. Because now you see, like now tomorrow's class will not be a free of charge class. You need to be in our paid WhatsApp group. Once you pay us the Kenya shillings 4,800, we put you in the paid WhatsApp group, and then we shall be able to overcome all of us. Otherwise, it has been a pleasure hosting it tonight. I'm looking forward to now meeting you in a full-scale class from tomorrow. Tell your colleagues in those intermediate levels that now we have begun. They need to join us, not yesterday, but today. We can't postpone. So many students in this case here fail because they tend to come after release of their exams, which in this case here makes them to do what? To fail miserably, Otherwise, thank you very much. See you tomorrow. Bye and bye. My students following me on YouTube, on whichever social media handles, don't forget to subscribe. Don't forget in this case here to like. And don't forget to give me the emoji which is smiling like that. Thank you. We shall overcome, yes. Then we have also, morning classes, yes. Morning classes run from 5 a.m. to 7. 5 a.m. to 7. Thank you, Maureen. We shall overcome. Bye. See you.